Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast.
Let's figure out what's happening down in Washington, D.C., because they have no idea what's going on down there. They're not even back like in session. I mean, they're coming back tomorrow. I mean, the government's about to shut down and they're still on some holiday.
I think it's very popular in Washington, D.C. to not do your job.
Right.
I think that's what the constituency wants.
You think so?
It seems like it.
All right. Nathan Dean, I'm going to blame him for all this. Nathan Dean is our senior U.S. policy analyst for Bloomberg Intelligence. His job is to make sure this government works. He's not getting it done here. Nathan, talk to us about where we are with this possible shutdown. What's the feeling in Washington, D.C. these days?
Yeah, so, over the weekend, Speaker of the House Kevin McCarthy talked about trying to pass 4 appropriation bills. There's been talk about some Republicans bypassing the speaker and working with Democrats to do something called a discharge petition. But if you're sitting in New York City, all you need to know is that nothing really has changed. I mean, we're heading towards a shutdown Saturday night. There's a lot of political fireworks that have to happen this week, but we just aren't seeing any movement at this point that the speaker wants to actually do a deal with the Democrats and try and avoid this type of situation. So I think we're probably around 70-80% chance that we're going to have a shutdown next week.
So, Nathan, is the choice for the speaker, I'm assuming, Speaker McCarthy is kind of driving the bus here. Is his choice, I do a deal with these radical Republicans, this small group of Republicans, or I reach across the aisle to Democrats and deal with the political backlash there? Is that his choice at this point?
There's no deal to be done with radical Republicans. They want to shut down the government, right? Isn't that what they want?
It's so much more of like, do I acquiesce to the radical Republicans and then shut down the government and then get to a point where the Democrats just say, look, we're not going to deal. I mean, the odds of what the Republicans, some of those conservative Republicans are wanting are less than a 2% chance of ever going to become law. And that's being grateful. So Speaker McCarthy's choice here is essentially saying, look, do I go through the motions of a government shutdown and then do I deal with the Democrats, or do I deal with the Democrats now and get it over with? Ultimately, this is ending with a deal with the Democrats. And so I think from the speaker's perspective, really what he has to do here is he has to do this deal, but he has to do it in a way that saves him face. Look, he's got to be showing that he's fighting for his ideals and so forth like that. And that's why I think he's going to accept a government shutdown. If he makes a deal before then, I think there were those people that are seeking to oust him get a little bit more ammunition saying, look, he didn't even fight, so let's just kick him out. So I think the speaker's just playing a little bit of what if scenario analysis here. But I think he's just going to say, look, we got to do this after sometime next week after the shutdown.
By the way, do we call them conservatives? Because they don't really act like that, do we? The Freedom Club people, Nathan, I mean, they're not exactly acting like Ronald Reagan or George H.W. Bush. It's more like, I don't know what word you use. How do you describe other than, radical populists?
Well, I could say somebody is a conservative Washington, and I'll get 100 different answers of what that means. But, ultimately what's going to happen here is it's the House Freedom Caucus. There's about 15 or so members, maybe as much as 20. But I would also point out that there's also another caucus called the House Problem Solvers Caucus. And one of the things that they're trying to do, and we've heard whispers on this, is that there's about 6 of them. It would take 6 of them to say, look, I'm going to bypass the speaker. I'm going to work with the Democrats on something called the discharge petition, where I can actually overrule the speaker. We'll have the Democrats have control of the floor. They'll make the deal. Now, I don't think Speaker McCarthy would be all that upset with it. Look, he could say, look, this is horrible that they're taking my power, so forth like that. But also it's a get out of jail card free for, free get out of jail free card for him. So, I think what the speaker is doing at this moment is just saying, look, I've got these people over here that want this. This is never going to happen. I got over here this idea of working with the Democrats, which I know eventually will happen, but I just can't go out there and say I'm ready to do it just yet. So unfortunately, it's the people that are going to be stuck. The American people are going to suffer a little bit because of this.
I mean, this seems from I don't know anything about politics and political calculus, but this seems like a disaster for the Republican Party. How is the leadership allow? A, is it a disaster? And B, how would the leadership of the Republican Party allow this to happen?
Well, it's not like they can come out and just wave their wand and say, "Do as I say." I mean, the Speaker McCarthy is,
Why not?
has
I
had
thought
to
that's why
navigate
we have
this.
whips and majority leaders and things like that.
You know,
I watch the West Wing.
If the party has fallen apart, if they've lost their minds, then
All right.
But
I'm
I
not saying
also
they
say
have,
that
but then you can't control them, right? I mean,
but if they also make a deal within the next 2 weeks or so, we won't be talking about this come January. We'll be talking about, the presidential election cycle and so forth. So there are people out there that say, look, shutdowns will be negative for the party that caused it. In this case, it would be the Republicans. But the independent voters' mindset is sort of short term. And per your inflation talk prior to this segment, inflation may be around in January, and that may be the big ticket. So there are some saying, look, shutdowns are bad, but how much of a political price we're going to have to pay? Maybe not so much.
it's a good point. But Nathan, let me get your take, speaking of inflation, on the UAW. And President Biden going there, which I think is, such an exciting story because I love the car makers, and now you've got these 150,000 workers that are potentially going to make a lot more money. It's inflationary. President Biden says he's pro-union, but he's also super pro-green transition and EVs, which the union feels is in some ways is like their enemy. How do you look at that whole situation? Does he have the vitality to go and stand on a picket line? I'm just asking that
for me,
question.
this is all about Michigan. He needs Michigan to win re-election, and going to that picket line is just a way to say that, look, Michigan is one of those 5 or 6 states that I need. Going there is just to make sure that President Trump doesn't steal the press cycle by him going there. So, the actions of President Biden actually walking the picket line and so forth like that, this was a political call. I'm not sure how much it impacts, I haven't looked at the impact of how it would impact the UAW negotiations, but this was an easy call for him to make, because if he doesn't go there, President Trump was going to go there, other Republican candidates would go there, and one of your key states would be, you wouldn't actually be in one of those key states that you need.
It'll be tough, though, if some of the workers on the picket line say, hey, Joe, what's with the billions of dollars in subsidies for electric vehicle transitions?
No, absolutely. He's going to have a tough time talking to this, but, President Biden also claims to be the most pro-union president ever, Scranton, Pennsylvania. This is something. So I wouldn't put it past him to be able to rely on some of the institutional knowledge he's had over those 70 years to try and go forth and, at least get some talking points out of there. So I don't think it's going to be that much impactful in the way of the negotiations. But again, it's a symbolic gesture that he needs to ensure that he wins the Rust Belt come 2024, because that and Arizona and Nevada are going to be pretty much all the states that matter going into this election.
So is the expectation in D.C., we're getting off the topic a little bit, it's going to be Biden for the Democratic Party? Is there any credible discussion otherwise?
No. Look, we're 3 months away from a primary process, and if President Biden were to stand up and say, look, I'm not going to run for president, who would take his place? Obviously, you have Vice President Kamala Harris, but, Vice President Harris was the first one to bow out in the the prior election. That person doesn't automatically get the party's mantle. So if President Biden were to say today, I'm not running, you would kick off a chaotic process in which the Democrats would be completely disjointed, and there'd be a really fast-paced fight to try and see who could win. Governor Newsom, probably Governor Pritzker from Illinois, for example. It would just be very chaotic. So I really don't see President Biden saying that he's done. I think he's in this for the long haul.
All right, Nathan, thanks so much for joining us. We can go a million ways with you. You've always got everything on topic. Nathan Dean, Senior Policy Analyst for the U.S. government for Bloomberg Intelligence. He's based down in Washington, D.C., and he is our go-to guy. So there's a lot of balls in the air down in D.C. Most notably, is this government going to shut down? And it looks like, appears at this stage at least, that the answer is probably yes.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Matt, you might remember 2 or 3 months ago, I took that whole recession talk off the table for me. But you know what? With this Federal Reserve higher for longer, I don't know. I think they might run the risk of pushing us into something that we don't really need. So I'm going to talk to and ask a professional about this. Lydia Boussour, senior economist at EY Parthenon. So, Lydia, was I a little bit early in taking the recession talk off the table? Is this Federal Reserve with its new, or not new, but continued effort to keep rates higher for longer, are they bringing that recession talk back to the forefront?
Hi, thanks for having me. The higher for longer interest rate paradigm that the Federal Reserve strongly signaled after the meeting, and with this new dot plot showing interest rates remaining above 5% throughout next year, means that we're going to be in that higher interest rate environment for longer, higher cost of capital, and that's going to be weighing on spending decisions for consumers and businesses. I think this is going to be an additional headwind for the economy. This has already been impacting the economy, but we do believe that there remains a pathway for a soft landing. I think it's important to keep in mind that these higher for longer interest rates are also a reflection of a more resilient and stronger economy, and also expectations for that strength to continue moving forward.
Well, first of all, Lydia, we just got a red hot sticky headline crossing the terminal and on China and the property issue there. So Evergrande unit missed payment on 4 billion yuan onshore bond. We've all been watching the Chinese property sector again lately, right? It looks worse than feared previously, and the short-lived boost it got from the Chinese sort of stimulus activities is gone now. Is it possible that this spreads around the world, or is it contained to the Chinese economy, you think?
We believe that China's economic slowdown has emerged as a top risk for the global economy. When we look at the U.S. in particular, when you purely looked at the trade linkages and financial linkages, they're fairly limited in terms of the U.S. exposure and looking at U.S. exports to China. But when you think about the impact on financial conditions and how that could potentially lead to a China growth scare, the way we saw back in 2015, 2016, that could have an impact on confidence, and that could have an impact on a more significant impact on the U.S. economy. Now, looking at the broader global economy, this is going to have some ramification for economies that are more exposed, and this is potentially leading also to a sharper economic slowdown globally. So
not the U.S., right, Lydia? When you say economies that are more exposed, I guess you're talking more about Europe than America.
Europe is more exposed, but as I mentioned, the U.S., the exposure is really more through financial conditions and a potential deeper global slowdown as some of the other trade partners for the U.S. get impacted as well.
Lydia, back here in the U.S., one of the real points of resilience in this economy has been the labor market. And a lot of folks are kind of confused about why this labor market is so strong, given the inflation out there, given the higher rates. How do you view and how do you explain the labor market to everyone?
We've seen some persistent tightness in the labor market and those lingering labor shortages in some sectors. So a lot of that tightness that we have seen is really tied to some of these post-pandemic labor market dynamics. We've seen a lot of dislocations during the pandemic. And so what we're seeing today is companies essentially holding on to their workforce, their talent, that they really had a hard time attracting and retaining over the past 2 years. So we are seeing some labor hoarding, and that is, one of the reasons why, even though you're seeing that rebalancing, even though you're seeing labor demand coming down, we haven't seen that a significant rise in layoff that you would expect in this environment of higher interest rates.
In terms of the path to a soft landing, with all the risks that you mentioned, Lydia, and we've been listing them here on Bloomberg Radio as well, from increased credit card debt to delinquencies on those cards and on auto loans, the return of student loan payments, higher oil and higher gas prices at the pump. What am I missing, Paul?
No, those are all good.
It seems like the strike, the UAW strike lasting a long time and expanding is a risk. I don't know if the government shutdown is a financial risk or if it's just an amazing annoyance. But all of these things are bad, right? So where do you see a soft landing coming out of that?
Yeah, I mean, we all these headwinds, the headwinds you mentioned, are really combining and will combine to slow down the economy. So we do expect to see a downshift in economic activity as we head into 2024. We think that growth will fall below potential, and then we're expecting a number of quarters where growth is going to be fairly modest as a result of some of the old headwinds, higher interest rates, tighter credit conditions, and still high inflation. And some of these new headwinds that you mentioned that are going to be waiting on growth in the fourth quarter. What's important to keep in mind with the strike, with the potential government shutdown, is some of the impact is going to be reversed in the first quarter of next year. So this is also something that I think is important to keep in mind when you think about the outlook. But certainly a nuanced outlook with a resilient economy, but some headwinds that are going to be waiting on private sector activity.
So, Lydia, we've seen inflation come down from the peak of 18 months ago, roughly. But now maybe the hard work starts, as a lot of economists are suggesting. How do you see inflation moving over the next 6 to 12 months?
Yeah, we are in the camp that maybe the last inflation mile won't be as strenuous as some people think. There is a lot of ground to cover in terms of bringing inflation back to target. But we still think that there is a disinflationary environment that remains in place. When you look further ahead at the next few months and going into 2024, when you look at core inflation, we are expecting to see more disinflation on the core side, with housing inflation having turned the corner, with the labor market loosening as well, and also with the fact that we're going to see a slowdown in demand and in economic activity, and that will put further downward pressure on inflation. So we think that we're going to see continued disinflation, and looking at core and headline inflation, it will still take some time, but by the end of next year, we may have gotten closer to the 2% target on both headline and core.
Lydia, how concerned are you about the European economies over there? I mean, we talked about it earlier, but boy, their exposure to China and it just compounds some problems over there. What's your forecast for just Europe and the UK going forward?
Yeah, we are seeing more weakness for the European economy, and we are seeing more headwinds as well from the China slowdown. When we look at economic activity, we are seeing some economic indicators pointing to a further downshift. And now the outlook is, not the same for each individual country within the Eurozone. We are seeing localized weakness in Germany, with this recessionary conditions in Germany. The UK is also showing more signs of weakness, but overall, this is a region where we are expecting to see more weakness this year, and this is going to be a soft spot for the global economy, along with the Chinese economy.
Lydia, thank you so much for joining us. Always appreciate getting your comments. Lydia Boussour, senior economist at EY Parthenon.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Jess Larson joins us. He's the CEO and founder of Briarcliff Credit Partners. He joins us live here in our Bloomberg Interactive Broker Studio. Jess, you guys just focus on this exclusively. Matt and I, we know private credit as like direct lending, but you're telling us it's more than that, right?
That is such a good question, right? And private credit means a lot of things to a lot of people. And there's a little bit of a misunderstanding that direct lending is all the rage of private credit. Direct lending is a great sub-strategy within private credit, but private credit is really a lot more. So what we have identified is 4 pillars of private credit. You got corporate credit, structured credit, real asset, and specialty finance. Underneath that, 26 different strategies.
Oh boy.
It doesn't matter where in the economic cycle we are, there's always strategies for you to make money. And that's exciting about private credit, right?
And private credit seems to me to come out of nowhere over the last 4 or 5 years.
Well, yeah.
Right?
I mean, I've been going to the Super Return Conference for the past, 7 or 8 years in Berlin, which was a private equity conference, right? But more and more of the people there are just talking about private credit, and a lot of the big shops that you think of as PE shops are actually, the majority of their investments are on the credit side now.
Absolutely. I mean, the big firms are pivoting from PE to private credit, right? What we're seeing right now is we're in the golden age of private credit. What we will see in 10 years, if I can be so bold, is in 10 years, private credit is going to be bigger than private equity.
Wow.
This is our age, right? And I have to say, Matt, Berlin is great. But next year, come to our summit. We had it last week. Over 100 LPs came to hear just about private credit. This is really a super
Where is
exciting.
it? Because the city's important to me.
We did it here in the Metropolitan Club. We made it easy for you.
I thought you were
we
going to
can
say
do
I
that.
could go to Copenhagen, which I would like to do.
That's where I'm from, but you're more than welcome. We can do that as well.
It's easier for us to take a subway to
That's true. Yeah, we can
Metropolitan
walk
Club.
to the Metropolitan Club.
We can
yeah.
do that as well.
We can do that.
Jess, talk to us about how this industry came about. Is it just simply the regulators put the traditional big banks out of this business?
It is a really good question, right? Because if we think about private credit, this is not a new thing. People have been lending to each other since the start of humankind, right?
Mm-hmm.
So you go back to Plato and those times, the Medici family, it was all about lending. Now, we called it usury at the time, but it was all about lending, right? So lending and private credit has been around since the early times. Now, you're right, during the GFC, we got the regulatory environment really supporting getting the credit out of the banks because it's not the right place for lending to mid-market companies and get it into the private credit space. So that was really the catalyst of what I would call the golden age of private credit.
The Germans would have a problem with that, right? Because that's their bread and butter of German banking. And I think, there's no sort of Mittelstand credit here the way there is on the other side of the Atlantic. But we would call that shadow banking. Is that a dirty term?
I think private credit sounds a lot better than shadow banking, Matt. Come on.
So it is, though, because you're pushing it out of the regulated banking sector into more of a, I don't want to say Wild West, because we talk to private credit men and women here all the time who are obviously very responsible, learned individuals, used to dealing with sophisticated investors, but you do have less regulation.
You do have less regulations. I would be contrarian and say we're pushing it out to where it belongs. Mid-market lending does not necessarily belong in a bank. We saw the risk you're taking on. If you're a mid-market company and you want to borrow some money, doing it with a bank adds a whole other layer of risk, right? We saw that with Silicon Valley Bank. We saw that with Credit Suisse and Signature Bank and so forth. Now, the private credit funds are set up and have a much better asset liability match. So this is a much better place for our mid-market. The economy needs it, right? The economy cannot survive without mid-market lending. So we need it, but we just need it to have it in a better place. And that's where we're going.
All right, mid-market lending. Do you envision the day when you characterize your industry as something more than mid-market lending? Not that that's not a great business, great returns, but bigger deals, bigger tickets. Is that where we're going?
That's also where we're going. I think you're 100% right, Paul. This market, in terms of private credit, is going to go from mid-market to upper market to where we need to be, right? Simply because it makes sense for the borrowers. If not, we wouldn't have it.
What about the lenders? I mean, right now, or previously, it was big institutional money, as I said, sophisticated investors, so people who, could afford to take losses. We've had people on the program that are looking to start platforms that allow retail money in. Mm-hmm. Is everybody going to get involved?
It's coming, right? We all need to be careful when there's retail money, right? There is a higher level of scrutiny, the higher level of regulatory environment when it comes to retail money. I think we started the right place with the big institutional money or capital coming from the pension funds, endowments, foundations, the big family office. We started with that money. We're slowly moving into the retail, but it does require a little bit more of a regulatory overview.
So what's a typical deal that Briarcliff invests in?
So we actually don't invest, Paul.
Okay.
What we really do is we take the smart funds and actually bring them out to the institutional investors. So
You're a placement firm.
We're basically a placement,
Gotcha,
yeah.
okay.
And we're the only one in private credit, believe it or not.
So you're the only one.
We're the
Placing.
only placement agent in the world that is completely
He wants to
focused.
hear the numbers. All Paul cares about in life is making money.
I love it. So there's 3,000 placement agents globally.
Okay.
There's only one that is dedicated to private credit. It happens to be in your studio right now.
So what are the deals look like? I mean, especially as in this rising rate environment. On the one hand, I think it's going to get juicy. On the other hand, I may be worried about companies that have to refinance or companies that have been lent to at much lower levels.
Yeah. I think it is a worry or it's an opportunity, which way you want to look at it. Because as we mentioned earlier, private credit is more than just direct lending, right? So there are special sits, there are distress managers out there. There are all sorts of strategies that can capitalize if the default rate starts to spike. Let's see if it happens. But if we are going to get more losses, there are credit funds out there that can actually capitalize and go in and save these companies. And that's what we need, where the banks would shy away, right?
Right,
but
because private lenders work more closely with management of the portfolio companies.
Yeah. Thank you for the pitch.
Well, I think we need to be skeptical as well. That's our job, right?
Yeah.
And I wonder what you do when regulation does come knocking, because there's going to be a day, when some senator gets a craw in her bonnet or whatever and decides you're the problem.
Yeah. Well, the question is whether it's a problem, but I don't think regulation is necessarily a bad thing, right? What we're doing right now is moving it out of the banking system to the private credit system where it is better placed. That's the first step. The next step is probably getting a little bit more oversight. And we are already seeing the regulatory environment starting to looking at valuation, reporting, and so forth. So it's coming, and it's a good thing, because it gives everybody a little bit more comfort.
Gotcha. All right, Jess, thanks so much for joining us. Jess Larson, CEO and founder of Briarcliff Credit Partners.
You're listening to The Tape, Cantor Live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
A little bit of news out of Amazon today. They are going to invest up to $4 billion in an AI firm by the name of Anthropic. It's a big number to me, $4 billion, but I guess if you're Amazon and you got a market cap of $1.35 trillion, maybe not that big a deal. But let's get
it is, though, because they don't typically go out and buy businesses.
Exactly. And I think this is big because it's AI, so I pay attention. Anurag Rana, he also pays attention. He's a tech analyst at Bloomberg Intelligence. He joined us via Zoom from his happy place, Bloomberg Chicago office. Loves that. Anurag, talk to us about this deal here, Anthropic. What's Amazon doing here? What does Anthropic do, and why is Amazon investing up to $4 billion?
Yeah, I think it's a little bit of catching up to do, because for the last 12 months, all we have heard is Microsoft and OpenAI investments, and how OpenAI has the large language models and the foundation models that people can use, but they only run on Microsoft's cloud. So Amazon does not have that relationship with OpenAI, so they are looking at other AI companies that have similar products, investing money in them, trying to offer that service, and that's really what's happening here for AWS. Remember one thing, AWS is a much bigger player in cloud infrastructure than Microsoft, and I think it's for the first time they've been caught on the wrong foot.
In terms of Claude, which is that name of their
what is it?
Claude. That's the name of the bot, the chat bot that Anthropy or whatever it's called runs.
Okay.
Right? What's it called? Anthropic.
There.
So in terms of Claude's usage, it's going to be all on now AWS servers, and it's going to use Amazon chips, which I didn't even know that they were, building this much of their own silicon. They have one chip for training. It's called like Trainium, and one chip for.
You're all read in on this.
Well, what's the other one? It's for like inference. It's called Inferion or something like that. How big of a business is that for them?
So these are all emerging businesses. I mean, financially, this is probably negligible compared to the size of the business right now. But this is one thing that I think that really stood out to us was Amazon's not talking about using NVIDIA chips for this, but their own internal one. Now, it's going to be a while before we really figure out if it works. But, if AWS is making a big splash around it, they're basically saying that we can run some of these foundation models or the large language models without the need of NVIDIA GPUs, which to me is a big deal. Most large cloud companies eventually will design their own chips and get them made only because they want to, have much higher performance than what they get from, let's say, an Intel or an AMD or anybody else out there.
So, Anurag, I'm probably like most investors out there. Like over the last 12 months, I've been trying to run around like crazy, trying to figure out how I get exposure to this thing called AI, which I don't even really know what it is, but I know I got to own it. So, NVIDIA, the chip stocks, maybe a Microsoft, something like that we kind of fell into. But I did not think about Amazon. And is that a problem for Amazon that it's not perceived to have a real AI angle?
Yeah, I think this investment is basically they're telling that they are also serious and they're going to partner with other people. Oracle, for example, is partnering with another company called Cohere in a similar way. For us, when you get rid of, or when you are over the hype of the chip makers, when you move on to the software side, then the clear winners actually are the cloud infrastructure companies, which is AWS, Microsoft, Google, and to some extent Oracle, because that's where you will host some of these models and do your work on it. And then on the downstream, you have companies like Accenture and Capgemini and so forth that will implement some of that stuff. So on the software side, cloud infrastructure is one of the biggest beneficiaries in our view.
Where did they get, by the way, their data sets? Because a lot of these companies, Microsoft has a ton of our data. Obviously, Apple has a ton of our data, but Amazon might have more of our data than anybody else, right?
Yeah, but Matt, they're not using your or my consumer data to run any of these things. What Amazon Web Services is selling is going to, let's say JP Morgan or Bank of America, and saying, if you want to train your models, we are giving you the raw material for it. We are giving you the computing power. We're giving you the algorithms. You bring your own data, keep it in a contained environment, and test it out. Whatever the results you get the benefit of it. They're basically just, selling compute power and storage. They're not really, selling their own or your and my customer data to these companies.
Is this a good deal for Amazon, and do they need to do more here?
Oh, they need to do a lot more. They need to do a lot more and actually showcase a lot of the enterprise use cases. Paul, what we have seen so far is a lot of use cases when it comes to consumers. So when we see what's happening with ChatGPT, because it has all the internet data behind it, we're seeing some of the stuff that Microsoft is doing because it has some of the user data around it, Excel and Word. But the real use case in the long run is enterprises, B2B. In the case of B2B, the data is disaggregated and it's in a lot of different systems. And it's people like Amazon, Microsoft, and Google that are going to sell the infrastructure and say, you create your own bots, you create your own large language model trained on your own data, but we're going to sell you all the services that allow you to do that.
So it's when I think about Amazon, the cloud is, they're such a leader in cloud. Can I not say that that's a way to play this whole AI thing? Because
this is the way, for software, that is the only way to play it in our view, because Amazon has over a 40% market share in cloud infrastructure. Oh. The problem was they didn't have a relationship with OpenAI.
Gotcha.
So today they are,
So
so companies that are selling the algorithms or these big foundation models that are called, or large language models, there are multiple companies out there, and you should expect to see multiple deals like this with everybody down the road.
Who has the best product? Have you been playing with all of the with Claude and ChatGPT and?
It all depends on who has the underlying data. If you're going to ask me who can summarize a picture for me or write a poem, that doesn't really move the needle for what I do. For B2B, it really needs to be able to get into enterprise data and figure out whether I have who's my best customer over the next 12 months. For that, I really need to tap into enterprise data warehouses, and that's not an easy thing to do right now.
All right. So what do you think is next here for Amazon in terms of their cloud, and maybe in terms of AI specifically, because they have no shortage of capital to invest here?
So they're going to make investments like this. They're going to invest in chips. They're going to invest in large language model. Margin is not going to be a problem. We are coming to a point that the tough comparisons for cloud decline is almost over. We are expecting a bounce back either the end of this quarter or perhaps next quarter, and then we should see a rebound next year, just because we have seen a fair amount of shrinkage or the usage of cloud over the last 12 to 14 months, and we are coming to a point where we should start to see a rebound. Now, that's irrespective of what happens to the AI, but once we see more AI investments, hopefully next year, that only adds to the fuel of the cloud rebound that we really believe in.
All right, Anurag, thanks so much for joining us.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We want to welcome our Bloomberg television and radio audiences worldwide. Joining us now, Amazon Web Services CEO Adam Selipsky. And Adam, welcome to Bloomberg Technology. I want to start with some of the mechanics of this deal. Does Anthropic still pay Amazon to use AWS Cloud? Or is it structured such that the investment that you make in Anthropic is in the form of cash and credits for AWS Cloud.
No, good morning, and thanks for having me. We're very excited for this expanded relationship with Anthropic. And the investment is a financial investment, as you say. And in addition, Anthropic will be training future versions of its models and running its models on AWS using our Trainium chips and Inferentia chips. Those models will be guaranteed to be available for years to come in our Amazon Bedrock managed service for LLMs, which provides a very wide choice of models. And AWS customers will actually receive early access to key features in Anthropic's models in the future, such as fine-tuning and customization of models. In addition, Anthropic's got very talented technical teams, and we anticipate working closely with them to actually improve future versions of our Trainium and Inferentia chips. So there are a lot of different benefits for our joint end customers from this relationship, and we're very excited to be leaders in this together.
Adam, there's a lot of emphasis on moving a maker of foundation models at that scale onto your proprietary silicon. How quickly will Anthropic start running AI workloads on Trainium and Inferentia?
Well, we've been working with Anthropic. They've been a customer of ours since, I think, their founding over a couple of years ago. And so they use a variety of different technologies for a variety of different workloads on AWS. They'll be using GPUs on AWS, and will also be using large quantities of Trainium and Inferentia. So I think everything's going to move very quickly, and it'll all be a mix of technologies depending on their needs at the time.
Adam, what's the mood like within Amazon and AWS this morning? There are lots of talented engineers that have been working on large language models, generative AI tools internally, and now you're turning to a third party who's highly regarded as a leader in building foundation models.
The mood here is great. We are a company of inventors who we love to build, and there's never been a better time to be a builder at AWS than right now. And as I mentioned before, a big part of our strategy in AI, and generative AI specifically, is all about customer choice. And there's not going to be any one solution that works for all customers, for all use cases. And Anthropic has done an amazing job. They're clearly a leader in this space. And it's really important for customers that we continue to generate new capabilities together. At the same time, really one of the hallmarks of our Amazon Bedrock managed service for generative AI is choice. And so Amazon is going to continue to build its own Titan models, which are going to be available later this year. Obviously, Anthropic's models are prominent in Bedrock, and we'll have models from other leading providers as well, as we have today. So it's still an amazing time to build here at Amazon. We think our models are going to be great as well, and it's about customers choosing the right tool for the job.
Talking about choice, and I just want to re-welcome our TV and radio audiences with Adam Silipsky. What's so notable is that, well, Anthropic took a chunk of change, $400 million worth, from Google already. And I'm interested as to how you feel that is perhaps a concern for you or not, the relationship that Anthropic already has with a previous cloud provider.
No, we feel great about the relationship with Anthropic. It's been a good relationship, and I think today's announcement just makes it a deeper and longer term. Anthropic will use AWS as its primary cloud provider for mission-critical workloads, including building foundation models and doing AI safety research, and will run the majority of its workloads on AWS. So we feel great about being able to provide the capacity and the expertise, and of course the security, the enterprise-grade security that is so important to AWS customers. And we also feel great about working with Anthropic to make sure that our Trainium and Inferentia technology, our chips, are as cutting edge as possible going forward for years to come.
I'm interested in drilling down sort of on where Ed was going about the feeling internally right now, because I look at some of the analysts' reaction to this, Adam, and Wedbush, for example, they say this signals a newfound urgency in Amazon's strategy to further integrate generative AI among your AWS suite of services. That urgency, was there a lack of understanding or indeed a reality that Amazon was behind the curve here a little bit when it came to the integration of generative AI? Because we've been looking at OpenAI and Microsoft for a while now.
Oh, we've been saying for many, many months, Carolyn, that we are fully urgent. We have a strategy that we really love. It is different than some other cloud provider strategies. It's true. We have a strategy of providing absolutely uncompromising security, which I don't think is true for all cloud providers. We have a strategy of providing customers the choices to use whatever's best for their job at hand. So Anthropic is going to be an amazing set of models for many, many use cases. And Amazon is fully invested in building its own Titan models, which I think will be really useful for other customers in other circumstances. And of course, our other model provider partners through Bedrock. So I really think it's an ill-founded premise that there's been some change in urgency. We're fully urgent here on generative AI for one reason and one reason alone. It's because our customers need us to have great generative AI capabilities. So many of them have their data platforms on AWS, and if you've got your data here, you really want to have your generative AI and all the powerful capabilities that you need from those capabilities in the same place. And so we have been, are, and will continue to be very motivated to deliver for customers.
Adam, what does this mean for the kind of ramp up or path forward for Trainium and Inferentia? You've put a lot of emphasis that Anthropic brings you a maker or creator of foundation models at scale. Will you now need to ramp up, I guess, your third-party manufacturing relationships to say, okay, let's get more Trainium, more Inferentia online to support the workloads?
Well, it's absolutely true that there is a huge demand for all of the different chips with which people do generative AI workloads. And so we absolutely have already been ramping up our training and Inferentia supply chain and ramping up the supply that we can create as quickly as possible. And yes, Anthropic will have access to very significant quantities of compute, which will have Trainium and Inferentia in them. So yes, that's one of many reasons why we continue to ramp up and to provide a very robust AWS-controlled supply chain for AI chips.
And is that where the revenue boost comes, Adam? Because we're looking at the share price reaction is higher on the day. When does this all start to really drive adoption, money, and the bottom line for Amazon?
Well, I think that AI in general, look, AWS has had machine learning services since at least 2017 when we released our SageMaker machine learning service, which has over 100,000 AWS customers on it. So we've been doing machine learning for a long time inside of AWS. And obviously, more recently, I've had a significant number of generative AI customers. And we will certainly continue to ramp up. I anticipate, quite steeply. We have many sources of growth inside of AWS. We're a scaled and relatively sizable business at this point. And customers are running their data platforms on AWS. They are building out more and more applications for things like supply chain and contact center management on AWS. There's still a whole lot of storage and compute and database workloads ramping in on AWS. So we have many sources of growth, I anticipate. But there's absolutely no doubt that generative AI looks like it's going to be an explosive additional source of growth in the years ahead.
Adam, we put a lot of emphasis on the up to $4 billion. And I understand and thank you for explaining how the relationship will work in practice. If I put to you, this is an example of Amazon or AWS basically paying a leader in the field of AI, handing over cash to make them use Trainium and Inferentia, how would you respond to that? And explain to me how you bring new customers on board who are really interested in the AI accelerators that you have built without having to invest in them as a sort of backer.
Sure. Well, I think the really big news today is the new expanded relationship between Anthropic and Amazon. in which they will have access to really large quantities of training and inferential chips. Customers will have access to those models, including early access to critical features through Amazon Bedrock. And Amazon will get to, AWS will get to work with Anthropic to ensure that we optimize our training and inferential technology going forward. That's the benefit for customers. And yes, as part of this, we're pleased to be making an initial investment of $1.25 billion into Anthropic. It's a financial investment, and that could go up as high as $4 billion, as you said, over time. But it's really driven around customer value and what this is going to mean to customers who are, very, very determined, as they should be, to figure out generative AI strategies. We already are working in depth with customers, as is Anthropic, on forming those strategies and actually moving to execution. We have a lot of great customers, from Lonely Planet to Nexus Lexus, and a number of others who are actually moving to production with generative AI on AWS and Anthropic. And in addition, as you alluded to, we'll be working with all of the partners that our customers want to do business with. If it's an important partner to our customers, it's going to be an important partner to us as well.
Amazon Web Services CEO Adam Selipsky, thank you.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Last month, existing U.S. home sales in the United States fell by 0.7% from the prior month. That's a 7-month low. So higher interest rates and a lack of supply contributing to those declines. Let's see kind of where we go from here. We can check in with Lisa Sturdivant, chief economist at Bright MLS. She joins us via Zoom. Lisa, again, there's really no supply out there. So the net result is not a lot of transactions. What do you see going forward?
Of course, have made it more difficult for buyers, but those higher rates have also caused a lot of existing homeowners to stay put when they might have thought about listing their home for sale. I think mortgage rates are going to stay elevated throughout the fall and into the winter. So I think inventory is going to still be very, very low for the last part of the year. I do think though we're going to start to see buyer demand pull back even further. You mentioned August numbers were the lowest we've seen in several months, and I think we're going to see an even further contraction of buyer activity in the market simply because those rates are so high.
Is there a rate, Lisa, that you think would entice people to come back into this market? I mean, we're now looking at the the 30-year fixed like 7.64% here. Is there a level, whether it's 6%, 5%, 4%, where people start coming back into the market?
Yeah, I don't think we're going to see 4% in any short order, for sure. I think it's not only about the level, but also about the timing. Last year, we saw rates go over 7%, like right around the beginning of November, and we saw the market just sort of shut down. People were reacting to the higher rates, but they were also reacting to the fact that the holidays were coming and people were sort of just going to take a break before they returned to the market in the first of the year. So I think if we see mortgage rates come down to 6.5%, which I don't think we're going to see until next year, frankly, I do think that'll be the level that will change the landscape for a lot of buyers and sellers, importantly, bringing more of those listings onto the market.
So, I mean, I guess the key issue here for most people is just affordability. I mean, given the mortgage rates and given where housing prices are, just the affordability is just the key issue here for a lot of potential buyers.
I think that's right. We've been talking about inventory as the main constraint on the market, but affordability is going to be more and more what we're talking about. Rates over the last 50 years, mortgage rates have averaged about 7.75% over the last 4 decades. So the rates we're seeing now aren't particularly high by historic standards. But what's very different is that home prices have been rising much, much faster than incomes over the last decade or two. And we're seeing now that affordability, when you compare household incomes to the price of buying a home, affordability is worse than it's been in history, and is really the main driver of people having to leave the market, particularly first-time home buyers. And that's a real problem, as the ability to accumulate wealth through home ownership is, there's an obstacle to that for many first-time buyers right now.
So where are first-time home buyers going? I mean, do they just continue to rent? What do they do?
Yeah, so there's a couple of things we've been seeing. We're seeing that first-time buyers are getting a little bit more creative. We're seeing more first-time buyers who might be, looking to buy a home with their parents, for example, or looking to buy a home where they could rent out part of the home to have that income, be able to make the monthly payment a little more doable. We're also seeing that maybe first-time buyers are more willing to take on a fixer-upper when that might not have been the case a couple of years ago. But frankly, we're seeing that folks in that first-time home buying age actually may be deciding that renting makes the most sense. As more apartment construction has come online, rents are actually falling in some markets across the country, and renting might be a better financial decision than buying at this point for those folks.
When you listen to the home builders, they talk about building these larger homes, the McMansions, if you will, because that's simply where the profit margin is. But arguably where the demand is, or where the need is for some of those first-time buyers of smaller homes. But are we seeing the home builders kind of move that way, or are they sticking with where the margin is?
Yeah, that's a great question. And, we have seen that the size of new build homes has come down. And I do think that is in response to the demand from first-time home buyers. The biggest constraint that home builders have really is the local zoning regulations on the ground that limit the amount of homes that they can buy. So you talk about profit margins. If builders were able to build more homes on a given lot, they could build them smaller and still make the numbers pencil out. And that really is, where the constraint is. Builders see that first-time home buyer demand, and if they could make it work in order to make a profit, they certainly would be building there. But there's still demand all along the price ranges, and so they're still seeing folks coming in for those larger homes.
Is the tightness in the real estate market, the lack of liquidity in the real estate market, are we seeing that across the country, or are there regional variances of note?
Yeah, I think we could characterize it as a tight inventory situation across the country for sure. But there are places where the market is loosening up a little bit. For example, we're seeing in markets that have been traditionally second home and vacation home markets, we're seeing those are places where inventory is increasing, perhaps as people who had purchased a second home or a vacation home, or maybe a home to use as a short-term rental, are listing those homes for sale. So we are starting to see supply growing in some markets, and I expect we'll see an uptick in inventory in other markets as we head into the end of the year and into the first part of next year.
If I want to get a mortgage, can I get a mortgage?
Yeah, you still can get a mortgage. It still pays to shop around for sure. We talked about what the average rate was on a 30-year fixed, but it obviously varies depending on the borrower. And I think the most important thing for a prospective home buyer right now is to make sure you're out there shopping around to find a lender who can provide you with the rate and the terms that make sense for your situation. More folks are looking at adjustable rate mortgages. We've seen in some markets where there are a lot of VA loans, for example, we're actually hearing more talk about assumable mortgages, which of course is limited to the VA product and to some other products. But I think you do need to cast your net a little bit wider to make sure you're getting all of the options that are available to you.
All right, Lisa, thank you so much for joining us. Really appreciate getting your thoughts there. Lisa Sturdivant, Chief Economist at Bright MLS. Again, it is a tight real estate market out there, folks. U.S. existing home sales fell to 7th-month low on rates and supply. That was in the month of August, down 0.7% from the prior month. So not a lot getting transacted out of there, not a lot for sale. And then if you do find something, we got to pay a pretty steep mortgage rate. We'll keep on top of that.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.